For decades, silver lived in the shadow of screens, tickers, and promises. Numbers flickered, contracts traded hands, and everyone believed the system would always deliver, eventually. But markets don't break with sirens and headlines. They break quietly when phones stop ringing, when websites freeze, and when reality refuses to match the price on the screen. What you are about to hear is not hype. It's not celebration. It's a field report from inside a market that just crossed a point of no return. Silver didn't just rally. It snapped the mechanism that was holding it together. And now the rules you thought governed price, liquidity, and ownership no longer apply. Yesterday felt like victory. Champagne narratives everywhere. The story was simple. The banks had lost control, manipulation was finished, and silver had finally broken free. Then today arrived and the phones went silent. Silver is sitting at $62.30. It didn't collapse. It didn't reverse. On paper, your net worth looks better than ever. But now comes the real test. Try to use that price. Try to take $62.30 and actually buy a physical ounce of silver right now. Go ahead. Call the largest wholesalers in North America. Reach out to Swiss refineries. Contact the Australian mints. What you'll get isn't metal. You'll get a deadline or a polite recording saying, "Due to extreme market volatility, we are not accepting new orders." This isn't a surprise. You were warned. When silver finally punched through decades of commercial suppression, it was never going to be a smooth ascent. This move was always going to break something. And now it has. What we're seeing at $62.30 is not a lack of silver in the ground. It's something far more dangerous, a liquidity failure. The physical supply chain has fractured. Refineries are pausing operations. Wholesalers are voiding contracts they confirmed just yesterday. Reports are circulating that the US Mint is under open-ended allocation. What? Because the price moved too fast. That sounds backwards, doesn't it? Higher prices are supposed to attract supply. That's Economics 101. But silver doesn't live in Economics 101. It lives inside a leveraged structure held together by hedges and trust. And at $62, that structure just turned toxic. This may be the most important warning I've ever delivered. I'm going to explain why the supply chain froze, how refiners walked into an impossible trap, why holding cash right now may be the most dangerous position of all, and why $62.30 is not a price. It's the last known coordinate of a ship that just disappeared from radar. If you're waiting for a pullback, you're already stranded. The window didn't close. It was sealed shut. Let's ground this in reality. As of December 11th, markets are supposed to have two sides, bids and asks. Buyers and sellers. Liquidity lives where they meet. But this morning, silver went bid only. Cash is everywhere, $62, $65, even $70, but there is no ask. Sellers are gone. A senior contact at one of the largest precious metals distributors in Texas told me this morning. We've stopped all sales. Our hedging line with the bullion bank is maxed out. We can't replace what we sell. The website is closed until further notice. Think about that. Silver at record highs and professional sellers refusing to sell. This is replacement risk. Picture a dealer holding a monster box of silver eagles bought at $30. Selling at $62 looks like a windfall until tomorrow. If silver jumps to $80 or $100 before they can restock, that profit turns into bankruptcy. They exchanged a rising asset for a collapsing currency. Veteran dealers know this trap. They survived 1980. They survived 2011. And now they're choosing metal over margin. Inventory has quietly become strategic reserve. That's why you're seeing pre-order buttons with delivery dates like February 2026. Don't touch them. That's not silver, it's an unsecured loan. At $62.30, the physical link is broken. And it starts at the top, the refineries. Refiners don't speculate. They hate volatility. When a refinery buys raw silver from a mine, it takes weeks to process. During that time, price risk is lethal. So they hedge by physical short futures. 1 million ounces in the furnace, 1 million ounces sold on paper. Perfect hedge. Delta neutral. It works when silver moves cents a day. It fails when silver moves dollars an hour. As silver surged through $60, margin calls exploded. The physical metal couldn't be sold, it wasn't refined yet. But the paper losses were immediate. Brokers didn't care about inventory. They wanted cash. Refineries didn't have it. So they stop buying, or no or in, no bars out. The paradox is brutal. The higher silver goes, the less silver gets produced. We saw hints of this in 2020 and 2021, but back then silver was cheap. At $62, the capital requirements are magnified. Margin calls are crushing. Production is frozen at peak demand. Then comes the next layer, wholesalers. These are the companies that turn 1,000-ounce bars into coins and retail bars. This morning, when refineries halted deliveries, wholesalers panicked. A source at a major Florida mint told me, "We sold 500,000 ounces yesterday. Our supplier just canceled next week's delivery. We're short. If we can't source metal, we're insolvent." Most of this industry runs on just-in-time inventory. When that chain breaks, the choice is ugly: refund cash or delay delivery and pray. And while wholesalers scramble, industrial buyers move fast. Tesla, Samsung, solar manufacturers. They don't care about coins. They buy bars, and they're paying $65, $70, even $75 for immediate delivery. They understand the freeze. They know if refineries stay offline, assembly lines stop. Retail investors are now bidding against tech giants. That bidding war has a predictable outcome. Within days, most online inventory will vanish. What remains will carry massive premiums. Spot at $62. Eagles at $100. That's not fear, that's arithmetic. Now comes the legal danger, force majeure. Buried in contracts is a clause allowing settlement failure during extreme volatility. If invoked, silver doesn't have to be delivered, cash will do. At a price they choose. Imagine silver hits $100, and your position is settled at yesterday's close. Perfectly legal. This is why the rule has always been simple: if you don't hold it, you don't own it. At $62.30, counterparty risk eclipses price risk. We are watching the final separation. For decades, spot and physical moved together. Now they're divorced. Spot is becoming a theoretical number. The real price is what clears in private deals, and right now that's closer to $80. If spot drops and premiums rise, you didn't get a discount, you got misled. Trust is evaporating. And when trust disappears, metals don't just rise, they vanish from official markets. We're not fully there yet. But when Swiss refiners stop answering calls, the event horizon has been crossed. At 9 a.m. this morning, the silver market passed the point of no return. And nothing that happens next will look familiar. So what happens next? If you think the chaos of the last 24 hours was extreme, you haven't seen anything yet. What comes next is the unobtanium phase, the moment when silver stops behaving like a tradable commodity and starts acting like a strategic resource. Over the next stretch of this story, I'm going to map out where this crisis is headed. I'll explain the subtle pivot that's about to inflate one of the largest stock market bubbles since the dot-com era. I'll break down the government's inevitable reaction, the regulatory pressure they'll attempt to apply to slow the bleeding. And most importantly, I'll show you why $100 silver isn't speculation, but a mathematical outcome of the breakdown already in motion. The easy part is over. Now comes the grind. To understand where silver goes from $62.30, you have to stop thinking like a trader and start thinking like a survivalist. Because once a commodity becomes unobtanium, price stops moving in percentages and starts moving in jumps. Unobtanium is a term borrowed from engineering and science fiction. It describes a material that is essential, but nearly impossible to obtain. And when something enters this phase, the price doesn't climb smoothly. It forms a vertical wall. We've seen this before with rhodium. When supply tightened and manufacturers panicked, the price didn't rise gradually, it exploded, moving from a few $1,000s to nearly $30,000 per ounce. Not because of speculation, but because automakers couldn't function without it. Paying almost any price was cheaper than shutting down production. Silver has now entered that same territory. Take the solar industry. Modern solar panel factories operate non-stop. They cost billions to build, employ thousands, and operate under strict delivery contracts. If the silver paste runs out, everything stops, production halts, contracts are breached, and stock prices collapse. So what happens when a procurement manager looks at the screen, sees $62.30, and hears that there's no inventory? He doesn't wait. He escalates. He calls competitors, vaults, private holders. He raises his offer again and again until someone finally agrees. That's how prices jump from the low 60s to triple digits, not through speculation but through industrial panic. Retail investors feel FOMO. Industrial buyers feel something stronger, fear of shutdown. And we're already seeing early signs. Major manufacturers are reportedly approaching mining companies directly, trying to secure raw production and bypass refiners altogether. Some are even offering financing in exchange for guaranteed delivery. That's the clearest signal that the supply chain is being rewritten in real time. At this stage, price becomes inelastic. No matter how high it goes, demand doesn't disappear because the asset is no longer optional. At $62.30, we're not near the top. We're at the base of the curve. Now comes the second wave of this shift, the miners. For over a decade, silver miners were ignored, underfunded, and heavily shorted. Many traded at valuations that made no sense. But at $62 silver, the economics change instantly. Imagine a miner producing silver at an all-in cost of $20 per ounce. When silver was $25, profits were thin. At $62, that same operation generates over $40 per ounce in margin. That's not incremental growth, it's an explosion in free cash flow. The market hasn't fully priced this in yet. But once earnings reflect the new reality, the repricing will be violent. And the refinery halt actually strengthens miners further. If refiners can't operate, miners become the new strategic reserve. Industrial buyers will come directly to them through contracts, partnerships, or outright acquisitions. This sets the stage for a merger and acquisition wave, tech companies, auto manufacturers, and even sovereign funds competing for mining assets. If physical silver is hard to obtain, miners become the next best exposure. But selection matters. Some miners hedge their production at low prices and won't benefit. Others operate in risky jurisdictions where governments may impose windfall taxes or worse. Miners in stable regions like Canada, the US, and Australia will likely command premiums. Now let's address the inevitable response from the system. Do not assume banks, regulators, and governments will allow silver to move freely to $100. When control over price is lost, the response shifts from markets to regulation. Expect familiar tactics. Sudden margin hikes designed to force smaller players out. Position limits that restrict long exposure while protecting large institutions. Political narratives blaming hoarders and speculators. ETF changes that disconnect paper silver from physical reality. When these measures hit, price may drop sharply in the short term. Headlines will declare the bubble over. But none of these actions create silver. They only suppress paper demand while the physical shortage remains. Regulation cannot refine metal. Taxes cannot increase supply. Margin hikes cannot reopen a broken supply chain. All they can do is increase volatility. Now, how does this move toward $100? First comes the squeeze, pushing price through the 60s and into the 70s as options hedging and forced buying accelerate the move. Next comes media attention, drawing in momentum-driven capital and pushing silver into the 80s. Finally, industrial capitulation takes over. Once manufacturers accept that prices aren't coming back down, they begin securing supply at almost any cost. That's what drives the final leg toward $100. It won't be smooth. There will be sharp pullbacks, fear-driven drops, and moments designed to shake weak hands. But the destination is driven by deficit math and physical scarcity. And then comes the most important question: when do you sell? The answer is not simple, but one thing is clear. Selling silver for depreciating currency defeats the purpose. If silver is at $100, it's not because silver changed. It's because the currency did. Instead, wealth preservation happens through swaps. Swapping silver into gold when ratios compress. Swapping silver into land, businesses, or productive assets when purchasing power peaks. The goal isn't a number on a screen. The goal is purchasing power. We are living through a historic shift. December 11th marked the day refineries halted, the supply chain fractured, and $62.30 stopped being just a price. For those who prepared early, silver is no longer an investment, it's insurance. For those still waiting for a pullback, understand this: the window isn't closing anymore. It's boarded up. This is the era of unobtanium. Hold steady. Ignore the noise. Focus on physical reality, not paper illusions. The system is panic buying, the price is seeking its true level, and one of the largest wealth transfers in modern history is unfolding in real time.